Good morning, everyone, and thank you for joining us for our first long-term care public forum. And now I'd like to introduce our commissioner, Michael Pichek.
Thank you very much, Pat, and good morning, everyone. Thank you very much for joining us. Really important topic here to talk about, important information to share, and we have some great panelists to do that as well. So really glad that we have the group that we do, and really glad that you can join us. For those that don't know the department's work very intimately, the Department of Financial Regulation regulates the financial services sector in Vermont. We regulate the insurance industry, the banking industry, the securities industry, and the captive insurance industry. And ultimately, the heart of that work is to protect Vermont consumers. We do that by making sure Vermont consumers get the 100% full benefit of their bargain when they enter into a relationship with any one of those entities. We protect that Vermont consumer by making sure those entities generally have good, sound business practices, and making sure those entities have the financial resources to make good on the promises that they're making to Vermonters. And we will be talking about pretty much each one of those today as it relates to long-term care insurance. You know, this is an area of insurance that is in some ways the most challenging, I think, in the entire industry. It is relatively recent, dating back to the 1980s, and it's been met with some significant challenges as there have been involvements in medical procedures in medicine and treatment. People are living longer. They're living longer with long-term illnesses. They're requiring significantly more long-term care today than they did decades ago when many of these products were first written. So ultimately, the question boils down to that balance. How do you make sure you as Vermonters get the full benefit of your bargain with these policies, while also making sure the companies remain sound financially, that they're able to continue to make good on the promises that they've made you, and that they maintain really good and sound business practices as well to keep them at the forefront of the industry and to keep them viable long term. You know, we've seen both of those things play out across the country. We have seen insolvencies in this space, basically insurance companies having to be taken over by an insurance department and wound down because they did not have enough money to make all the promises that they had made. And we've also seen extremely large rate increases across the country, rate increases that make it really difficult for individuals to pay their premiums and keep their policies in place. So our department's really been laser focused on trying to find a balance between those two extremes. Neither extreme is good for consumers, but we need to find a balance to make sure that the companies are able to continue to make good on the promises they made you, and that you're able to continue to keep your policies and do so in a way that's affordable to you. So this presentation today will talk about those items. We're lucky really to be joined by some leading experts, not just here in Vermont and within the department, but nationally in this space. I encourage you to certainly ask questions of them. For those of us that are at the Department of Financial Regulation, I encourage you to keep track of names and faces, and make sure that if you have questions after this presentation, that you follow up with us so that we can get all of your questions answered and get you whatever information that you might need. So with that, I do want to turn it over to Emily Brown, who's going to kick off the discussion, lead us through the agenda, and make the introductions of the other panelists who will be joining us today. So again, just want to thank everybody for joining, thank the department for organizing this and putting it together, and thank our panelists who have joined as well. Emily?
Great, thank you, Mike. Thanks, Commissioner. Hello, my name is Emily Brown. I'm the Director of Rates and Forms at the Department of Financial Regulation. And the Rates and Forms section is responsible for reviewing the long-term care insurance products and rates filings, which we'll be discussing today. The goal of today's forum is to help the Vermont community gain a better understanding of long-term care products in general, understanding the marketplace in Vermont, as well as why and how the rate increases are being implemented, not only in Vermont, but countrywide. To help us with this task, we'll first be hearing from Vince Bodner, who's going to lead us through some basic concepts of long-term care insurance as well as rate increases. Next, we'll have our own Anna Van Fleet speaking with us about department's rate review process, resources are consumer. We'll then have a short break before we hear from several company representatives on their perspective of the long-term care insurance marketplace, as well as specific information about each company's presence in the Vermont market. We'll also have the pleasure of welcoming Bob Burke to talk about the Vermont Life and Health Guarantee Association. And if you don't know what that is, Bob's going to help us understand that. So I think now I'm going to turn it back over to Vince Bodner. Vince is recognized as one of the leading long-term care insurance experts in the country. He's worked with such products since the 1980s and helped regulators as well as industry representatives develop innovative solutions for new products and in-force block management. Vince was recently named one of the 20 most creative people in insurance by ThinkAdvisor. His long-term care insurance experience includes both standalone long-term care products and combo products, which is when a long-term care insurance product is sold with an annuity or life insurance chassis. And just to note, we will give audience members a time to ask questions after each presentation. You have the option of typing a question into the chat box feature in Teams, or you can also use the raise your hand feature, which you might see in your options bar as a little hand. And once you click on that, the moderator will indicate to you when it is your time to ask a question. And unfortunately, we probably won't have time to answer everyone's question today. If we don't get to you, I would encourage you to follow up with the department after the presentation, or contact one of the company representatives who can help you with your question. We also ask that if you have a specific question about personal claim or personal information, you do not raise that on this forum today. You can contact the department, as I said, or contact a company after this call. So now I'll turn it back over to Vince.
Thank you, Emily. I am hopefully I'm going to try to share my screen in order to give this presentation. Let's see if I can get that to happen. There we go. Hopefully you can now see my screen. Let's see. Yes. So hopefully people can see my screen, and I am going to also share my camera here. Oh. Looks like I cannot do that. Okay, so I am happy to be here to give this presentation. As Emily said, I am with Oliver Wyman, but I'm giving this presentation in a role that I have with the Society of Actuaries. I am the long-term care insurance section on the council for the Society of Actuaries. This is a presentation that the Society of Actuaries will give from time to time in these types of forums. So this is meant to be very educational and a neutral presentation of the mechanics of long-term care. So as Emily said, the purpose of this presentation is to give some basic explanations of a few things. One, long-term care insurance product features. Two, how actuaries price these products. Three, how we set reserves, which is a very important component of long-term care insurance, and how premium rate increases are determined and what causes them. I am picking up on a little bit of feedback, so perhaps if you're not speaking, if you could mute, that would be helpful. Also, this explanation is a very simplified explanation of all of these items. It's meant for a non-technical audience, such as the one we have in this forum. So just to start off with the basics of long-term care insurance. Long-term care insurance benefits pay out when an insured becomes disabled. And this usually is defined in your policy as requiring help with 2 out of 6 activities of daily living, or someone that needs help with a cognitive impairment, such as Alzheimer's. Many of the policies that people have also require not only that the insured be disabled, but that you be receiving long-term care services either at home, in an assisted living facility, or in a nursing home. So they're the three most common places that long-term care services are delivered. Long-term care insurance benefits are not paid out as a lump sum as a life insurance policy would, for example. Typically, a benefit is paid out each day that care is received, up to a maximum amount per day, so a maximum dollar amount per day. Most policies do place a limit on the amount that's paid out. Many policies do not pay during the entire disability episode. They may only pay for a period of 3 or 4 or 5 years. Some do have unlimited benefits, but many have some kind of limit. Also, many do not pay until the disability lasts a certain amount of time. That's called an elimination period. Many require a disability to last 30, 60, or 90 days before benefits are paid. By law, long-term care policies must cover the insured over their entire lifetime while he or she is paying premiums. So this is unlike a major medical plan or other types of insurance that might have a term period to it. Long-term care policies are guaranteed renewable for life as long as you pay your premiums. And since they are meant to be, it's meant to be a lifetime coverage, these policies required an offer by the insurance company to have an optional feature for inflation benefits, which means your benefits would automatically increase each year to keep up with the cost of care. The chance of using your long-term care benefits do change over time. There's a low chance of use for married couples, and many people buy long-term care insurance while they're married, although people do as well. So right after purchasing the coverage, and this is usually because of underwriting, and people tend to buy it when they're younger. There's a higher chance of using long-term care as people become single. So for individuals living at home or alone, your chances of needing formal long-term care services are higher because your spouse or partner is not there to take care of you. And then also as you age. So this means that the chance of using your long-term care benefits increases greatly after you purchase the coverage. So it's very low in the beginning, and it becomes higher as the policy ages. As I said earlier, premiums are meant to cover you for your entire lifetime. So in general, they do not increase by age, and this is also a regulatory requirement. So the actuary who develops premium rates, we use our actuarial models to develop a premium rate that is meant to stay level over the course of the policy's life. However, as I showed you before, claims are expected to increase over time. And so we have this pattern that creates a cash flow mismatch for insurers. Premiums are coming in at a steady rate, but claims will increase. And this is just the nature of a long-term care insurance policy. So companies are required to set aside some of the premiums that they collect in the early years while claims are lower into a reserve. And after the claims reach a certain point, or after a certain period of time, the insurers use this reserve to fund claims while claims are higher than the premiums that they're collecting. Not all of the premium dollars that you pay to an insurance company are put into this reserve fund, however. Some premiums are set aside for other purposes. First is policy administration. And this is to really pay the costs of administering the policy, collecting premiums, and having the people on staff to answer your questions and pay your claims. These costs are referred to as policy administration costs. Agent commissions, a portion of your premium dollars are used to pay the agents that sell the policies. State and federal income taxes need to be paid from these dollars, and some is used to distribute to shareholders as a profit. The remainder is what we call a net premium, and that net premium, this portion of it, is put into the reserve fund to pay future benefits. And another way to think about this reserve fund is a savings account. And you can think about the net premiums that you're paying as the deposits that are going into this savings account. And when policyholders need to draw on their benefits, they are withdrawals from the savings account. And like a savings account, this reserve fund does earn interest. The savings account is not really set aside for you as an individual, it's set aside for the benefit of all policyholders. And it can be used to pay the benefits. It can only be used to pay the benefits for those people that become disabled. It's not paid to people who die or stop paying premiums, unless there's a specific feature that allows for that in your policy. But in general, there is not. You can think of the net premiums as a scheduled deposit into this savings account. And this amount, the amount of this scheduled deposit, again, it's determined by actuaries. It's established at the beginning of the policy based on a few things. One, the most important, is how much will be needed to pay in policyholder benefits later on. And the second is the interest rate that will be earned. And if either one of those estimates are different, the account may not have enough to cover future withdrawals. So if you just haven't put enough into the reserve account, there will not be enough money later on when benefits need to be paid. And so a few things can go wrong. First is the interest rate. The interest rate can change if the economy changes, and I think most of us recognize that that certainly has happened in the last 30 years. And so we've seen a dramatic drop in interest rates. In the 1990s, interest rates were between 6 and 8%, and that's what companies assumed when they established their premiums. Now we know rates have dropped, and most insurance companies are earning 3 and 4 portfolios that back these products. The second category of items that affect the premium rate are the amount of benefits that are paid, so the withdrawals from the account. And that is dependent on three key things. First, the number of people that keep their policies up to the point when benefits are paid. Second, I'll expand on that. So for example, if the actuary had assumed that in this example, there are 20 people issued a policy, and if later on, say 20 or 30 years, there are 9 people, the actuary may have assumed that 3 out of 9 people, or 1/3 of the people, would use their benefits. If in reality, instead, you have 12 people, and the same 1 in 3 people go on claim, you now have 4 people going on claim instead of 3. Although there are more people in the population, we did not count on having to pay 4 people, and so even though there's a few more people in the population, they did not pay enough premium over their lifetimes to fund the 4 claims instead of the 3 claims. And this has happened to the industry. More people have kept their policies than we originally expected. People are living longer than originally expected, and they've kept their policies more than we expected. Second is, of the people who keep their policies, the number of people who use the benefits. And if we go back to this example of 20 people in the population, and again, we had 9 people left, in 20 years later, and 1 in 3 use their benefits. But in reality, of the 9 people, 5 in 3 use their benefits. Then again, there will be more payments than were expected. In general, the industry experience on this particular assumption has been mixed compared to what was originally thought. It's been, more for some insurance companies and less for other insurance companies. So again, this has been a little mixed. The third element is the amount that's paid out to those people who do use their benefits. So we could have gotten the other 2 assumptions correct. How many people live for 20 years, and then how many people use their benefits. But if we missed the estimate of how much will be paid out to everybody who uses it, that will also cause a problem. And again, long-term care benefits are not a lump sum. They're based on a few things. First is, how many days people will be disabled, the intensity of the care, and the cost of that care. And again, when we priced these products in the 1990s, we used the experience that was available at that time. And what we have found is over time, the length of time in nursing homes has not really changed much. So people are living in nursing homes about the same amount of time as they did 20 years ago. However, we're seeing more people receiving care in other settings, such as assisted living facilities, where people do live longer, and this is netted out to more benefits being paid than was originally expected. And so now we'll get into what is done when these estimates are not realized. If you think about a simple savings plan as an example, if you think you need $10,000 in 10 years, and we've removed interest from this just to keep this example simple, then you should have a goal of setting aside $1,000 a year for 10 years. At the end of that, you'll have $10,000. If something happens during that time, say after the 6th year, you suddenly realize that you need $12,000 instead of $10,000, then you're going to need to increase what you're saving by 50%. So you're going to have to increase your savings from $1,000 a year to $1,500 a year in order to meet that goal. So that's quite a large increase if you realize that you need just 20% more at the end of that 10th year. With hindsight, though, if you had known this from the beginning, you would really only needed to increase your deposits by 20% to meet that goal. And this is an important illustration because we often hear that with these large rate increases with long-term care insurance, there's an assumption that if you needed a 50% rate increase, then the insurance company underestimated what it would need to pay benefits by 50%. And often that's not the case. It's more a function of realizing that more benefits would be paid out, midway through the period of the policy, and you have what we would call a rate increase it's almost like catch-up rate increase to make up for the fact that the premiums that should have been collected were not collected during that period. So if we take that simple example and apply it to a long-term care insurance block of business, it would look like this. The reserve fund, at any given point in time, the reserve fund plus the projection or estimate of what the future net premiums will be, so future deposits, need to be enough to pay for the estimate of future benefits. And again, the savings account plus the future deposits have to be at least equal to the future withdrawals. And in this case, the two sides are in balance. There's enough to fund the future benefits. However, this can get out of balance. So if at any point in time, the reserve fund or the savings account plus the net premiums, the future net premiums or future deposits are less than the future benefits or withdrawals, you have an equation that is out of balance, and there will not be enough funds to fund these future benefits. So in this example, the reserve fund plus the future premiums with a premium rate increase is enough to fund these future benefits. So in this case, balance in this equation is restored by rate increases. However, in some cases, a premium rate increase is not enough. For whatever reason, the premium rate increase either asked for or approved was not what was needed to fund future benefits. And in these cases, the money does have to come from other funds. And insurance companies can't print money, so there's really only a few other sources that it can come from. The first is to pull it out of the company's surplus, so to make a one-time deposit from the company's surplus. And that surplus is held for the benefit of the policyholders, that all policyholders that have policies with the insurance company. And so it would have to come from that. And in some cases, the surplus is quite small. And so this can cause an issue for some companies. Or it can be taken from other policyholders. And in this case, it's taken from other, you do this by charging higher premiums or taking it from other lines of business, which is really, it's what we would call a subsidization. And so, I mean, this is really the challenge that, faces the industry and regulators at this time. What is the proper balance here? Should the company pull from its surplus? And again, in many cases, that surplus might not be sufficient, which can create other issues, or should there be some kind of subsidization? And so hopefully this presentation was helpful and provided some of the basics that can lay some groundwork for some of the discussions and presentations that you're going to see for the rest of the session. Happy to take any questions. I will stop sharing my screen and see if there are any.
Well, thank you so much, Vince, for that important presentation. And we have asked for questions from the audience. You can chat, or you can unmute yourself and ask a question. So we do have one question that has been asked, Vince. People who have paid for years should be grandfathered and not have to incur these rate increases. Was that a consideration?
So, that is certainly, an option that regulators and insurance companies do struggle with when they request these rate increases. I mean, the issue there is that the money has to come from someplace, which I demonstrated on the last slide. It would have to come from the surplus or other policyholders. So that would really be a policy decision. But certainly when the products were priced, it was known at the time that if experience would, if something would happen, that really rate increases were an option that are in the contracts and something that insurance companies relied upon when policies were priced.
Okay, very good. All right, and I don't see any other questions at this time. So we do remind everybody, feel free to chat a question or to call our Consumer Services Department. We have people standing by every day, but especially today to answer your questions. Okay, and so now I'm going to turn it back to Emily Brown, who's going to introduce our next speaker.
All right, thank you, Pat. So here to represent the Department of Financial Regulation to talk about the department's role in the long-term care insurance market, we have Anna Van Fleet, who is our own resident long-term care expert. Anna became a licensed insurance broker in 2008 and has assisted employer groups with wellness program delivery and claims analysis. Over the past 7 years at DFR, Anna has served in both consumer services in the rates and forms section, and she is a graduate of UC Berkeley and has a background in marketing. So Anna, I'll turn it back over to you. Thank you.
Thanks, Emily. Can you guys hear me okay? Great. Good morning, everyone. My name is Anna, and I often am the one who talks to consumers on the phone when they have complicated questions. So putting a face to the name, today I'm going to speak a bit about the department's role in handling the requests that we get from companies to increase their rates. I'm also going to share some perspective for consumers who might be facing rate increases. Hi. Did you hear my first part? Okay, that's weird. I don't know how I got muted again. Here I am again. Long-term care insurance helps you with the costs of help with activities of daily living. Some of these activities are eating, bathing, dressing, toileting, even transportation, laundry, and housekeeping could be provided. Also, social and recreational activities might be provided. When a policyholder needs help with two of the major activities of daily living, that's called a benefit trigger, and that's when benefits become available under your policy. I'll just tell you a few things about long-term care insurance. It's medically underwritten, and that means that insurance companies can select risks and charge different rates to different people based on their health status. Long-term care insurance is priced by age, and so it is more expensive to purchase a policy as you grow older. Long-term care insurance may be priced based on your gender, and when it is priced this way, women will typically pay more than men, and that is because commonly partnership, the woman is more likely to outlast the man and need caregiving support. Long-term care insurance is state regulated. That means different states have different laws. So it's very important to know where your policy was purchased, because that is the state regulation that will govern your policy. And that's the insurance department that will regulate your policy. Different states have different laws, but we do have a lot of similarity between the states, especially when it comes to some of the actuarial standards that govern pricing. And I'll talk about guaranteed renewable as a policy feature of long-term care insurance on the next slide. What does it mean that a contract is guaranteed renewable? Guaranteed renewable does not mean, well, first, on the first page of a policy, a long-term care policy, it will share the information right away that premiums can increase. So guaranteed renewable is a kind of a tricky term. A lot of people think it means that your premiums can't go up, but there's another insurance term for that, and I'll get there. What guaranteed renewable means is that a company cannot non-renew or cancel your coverage except for fraud or failure to pay premiums on time. So if you do have a policy, you might look on the first page for some language like this. There is a term for a contract that also has premiums that must stay fixed for the lifetime of the contract, and that's called non-cancelable. So if you had a guaranteed renewable long-term care policy that couldn't be canceled, and you had a non-cancelable feature, that means premiums will never go up. Together, that means that your premiums won't go up and your policy can't be canceled. So it's pretty rare, but there are some policies that are non-cancelable that have this feature. But most people do have a feature right on the first page of the policy that says that premiums may increase in the future. Now I'm going to talk about the life of a long-term care claim. When a policyholder needs help with 2 activities of daily living, benefits become available, and this is called a benefit trigger. There's usually some kind of assessment by a medical professional to ensure that everybody agrees that these activities of daily living are really challenging. Then there's an elimination period. And the elimination period is like a deductible. It's an initial cash outlay before your insurance starts to pay. 0, 30, 60-day, and 100-day elimination periods are common. Before you increase your elimination period, make sure you can pay for care. And that's part of the reduced benefit discussion that we'll have in just a moment. After the elimination period, the benefit period of the long-term care policy begins. And that's the duration of benefits. Typically, companies sell 3-year and 5-year policies. Some policies were sold with a lifetime benefit. Your coverage choices determine the cost of your policy. I'll talk about a few of these because they're really important to understand what feature you have in your current policy, and if you're facing a rate increase, you may choose to reduce your coverage so that you can keep the policy in force. These are the features of your policy that can affect the amount of premium that you're paying. We just spoke about the elimination period, and that is a cash outlay by consumers before the policy starts to pay. Vermont has a maximum elimination period of 100 days. And some common configurations are 0, 30, 60, 90, and 100 days. The care setting really does determine how much benefit you're pulling out of your policy. So different settings will have different costs. Now, most policies should cover all of these care settings. So if you have any questions about that, please do contact us. Nursing home, assisted living, home care, and adult daycare are all typical settings that are covered, that offer some kind of coverage in a long-term care policy. The benefit amount is the amount the policy will pay per day after an elimination period. The benefit amount is a maximum. So there's both a maximum amount that you'll be able to pull out of your policy each day and a total policy maximum, which I think of as the bucket of money that you have to pay for your long-term care expenses. Many consumers consider lowering the daily benefit amount as a last resort. The duration of benefits is called the benefit period. Oh, we've already done that. Typical companies sell 3- and 5-year policies. Some policies are sold with a lifetime benefit period. Most companies have stopped selling lifetime benefit periods because it creates an unending potential liability. What that means is if you have lifetime benefits, you may continue to use your benefits for 3, 5, 10, or even 15 years. It can generate significant claim expenses for the company. And so we would consider this to be a very valuable benefit for consumers. It is also a place where you might be able to reduce your benefits and still pay less in premiums and still have a pretty good benefit. Lastly, I'll just say that inflation protection has an impact on premium rates. This feature allows the daily benefit amount to grow over time. If you have 5% compound inflation protection on your policy, that's something we would consider to be a rich benefit because your policy has been growing faster than the cost of care. Typical inflation options are 5% compound, 3% compound, 5% simple, and 3% simple compounding. In Vermont, and in all states, the insurance department reviews and approves rate increases for individual and group policies sold in that state. So we review and approve rate increases for individual and group policies sold and issued in Vermont only. So if you did purchase a policy in a different state, but you moved to Vermont, it's still that initial purchase state that would be governing your policy. The only exception to the rate increase requests that we review, so the only exception is that there is an interstate compact. And that means that a bunch of states have banded together to have products approved and sold through that compact. And so we do not approve those rate increases. And if you have questions about whether you have a compacting policy, please contact us and we can help you determine that. If the compact finds that a greater than 15% increase is justified, they will send that to the state so we can have jurisdiction over that. What do we do when we review the rates? We make sure that benefits are reasonable in relation to premiums. And this is a technical actuarial term. And we have lots of really great experts looking at these filings. We call it kicking the tires to make sure that these benefits are reasonable in relation to premiums. We do sometimes lower the amount that we consider to be a justified increase. So a company may ask for an 80% increase, and the department may find through its review, for instance, that we may approve just 72% of that increase. Insurance carriers are required to spread larger increases over several years in an effort to reduce the impact of these rate increases and to allow you, the consumer, to have more time for financial planning. We are bound by law to adhere to actuarial standards in the regulation, but we do accept consumer comments and they will become a part of the permanent public record. Now I'll take you through the life of a filing, just so you can understand the process. And this process can take sometimes even 6 to 9 months. When we receive a rate request, that means the company has determined that they need to collect more money in premium to pay future claims. And so they bring that request to us and we are required by law to consider it. A request is submitted through the System for Electronic Rate and Form Filing System, and that's called SIRF. And that contains the rate increase request. It is available through public access, and it can be a little hard to look at a rate filing. So if you have questions, please reach out to us so we can help you find the pertinent information. We also ask that companies, this is a new requirement, we ask that companies give their policyholders a heads up when they file a rate increase. So starting September 1st of 2020, we've asked companies to notify consumers when they request a rate increase from us. So that's at the beginning. This is not a note to take action. This is a note to start considering what you might need to do in the face of a rate increase. So there is an initial notification when the request is filed. It's for your information, not for action. Once we've received the filing, we send it to our contract actuaries who are independent and professionally certified to complete the actuarial review. They check for compliance with Vermont laws and regulation, and we go back and forth with the companies to request any additional information that we may need to make our determination. When the review is complete, an actuarial opinion is created. And these are publicly available documents. And so this opinion tells us whether the rate increase is justified or it needs to be adjusted downwards to be approved. The department takes our final decision to approve, deny, or revise the request. And then we approve the filing, and the insurance company must give consumers 45 days advance notice before rates change. So there's a department approved letter that would talk about your current rates and your future rates and what options you might have. And just note, please, that the options that you might receive in a letter are not all the options that are available to you. They're just a small selection of some ideas to change your benefits if you need to. I won't spend a lot of time on the technical terms of loss ratio, but I do just want to share some information about when long-term care products are first filed, they are required by law to spend 60 cents of every dollar collected to pay claims. For a rate increase, the standards are higher. So when a company comes back to ask for a different rate for consumers, they must show that 85 cents on every dollar is going to be used to pay future claims. So the standards are certainly higher for these rate increases. DFR is bound by the regulation for the long-term care regulation, and we cannot reduce rate increases below the actuarially justified amount. And this is to make sure that companies are there to pay benefits when you need them. I've put on the screen a 3-year implementation plan exhibit. In this example, we received an increase request for 133%. After our review, we lowered the justifiable increase to 113%. Then we made sure we spread the increase out over 3 years with about 29% increase each year. As you can see at the bottom, we do show this is a section that should appear in every policyholder notification letter. It's very clear to show this is your current annual premium. On this date, this will be your new annual premium. And it also shows the second and third phases of the rate increase. So we really want you to be prepared for everything that's coming so you can make the best decision for you and for your family. I will just say, you know, these numbers are large, right? Current premium, $3,800, increasing over a few years to $6,600. That seems like a very significant rate increase, and we agree that that is a very significant rate increase. So I'll just say a few things about that, and not to minimize the impact of these rate increases. Just so you know, if you were to shop for coverage now, it's very likely that you'll find your rates are lower, even with the full increase implementation with your current coverage. They're getting better and better at pricing these products. And if you were to shop around and you did find a better policy or a better deal, please make sure to get the new product in place before you let go of the old product. It's very, very important. And I'll just say, Vermont consumers do pay some of the lowest premiums for this coverage in the country. Now I'm going to talk about reduced benefit options for consumers. I won't spend too much time here. We've seen this slide before. Just to remember that these are some of the choices that will determine the cost of your policy. These are some of what I consider to be the levers that you can play with to change your coverage and possibly affect your premium. And then just to remind you, there are two policyholder notifications. The first one is the notification when a company has made a request to us. So right after they file, I call this the heads up. Heads up, consumers, we've filed for an 80% rate increase. The department may not approve it, but this is just letting you know. The take action notification comes 45 days from your policy anniversary date. And this notification will tell you your current rates and your new rates and when they're scheduled to go into effect. If there's scheduled to be a phased in rate increase, you should receive all premium dates and premium amounts in the phase in process. All of those amounts have been approved by the department. The notification, the take action notification, as I've said before, it will include your new rates. It will include some reduced benefit options. It will also include what we call limited benefit options. And limited benefit options are, it's kind of like you walk away. Oh, I've had enough. If you decide that you don't want to put any more money into this product, there are options to keep some coverage in place so that, but we call them limited benefit options because they are a significant reduction in the value of your policy. We do not encourage policyholders to reduce the value of their policy in this way unless there are circumstances such as not needing care in the future. All of these decisions are important and deserve conversations with caregivers, family, and financial advisors and insurance agents. The most popular choice by far for consumers facing a rate increase is to keep the policy you bought unchanged. We've seen data from companies and generally across the board, about 80% of policyholders facing a rate increase will pay the increased premium to keep the coverage that they selected a long time ago. And again, Vermonters do pay some of the lowest premiums in the country for identical coverage. It's very important for you to know that you always have the right to reduce your coverage. You always have the right to change your coverage to lower levels to lower your premiums, even when you're not facing a rate increase, even in the middle of a policy year. So please do not feel pressured. Before you take the step of lowering your coverage, please talk to people you trust about it. The company sells product options, and if there is a lower value option that was sold in Vermont, you have the option to lower your coverage to that level. The only exception would be if you are already at a state minimum. For instance, if you already have 100-day elimination period, by law, the company can't offer skinnier coverage than that. So you would have to keep that benefit where it is. The state minimums are: elimination period cannot be more than 100 days. No daily maximum may be lower than $75. And no policy may offer less than 1 year as a benefit period. If you have no inflation protection, you wouldn't be able to lower that either. However, companies have come up with what they consider special offers. And these are some, and you'll hear from the companies, they have come up with some ways to change your benefits that they consider to be a new policy configuration that has not been approved in the past. These special offers may be limited to your decision window when facing a rate increase. So you always have options, but some of the options might be limited. So it's important to note and ask questions if you have them. You'll hear from some of the companies about customized landing spots, such as a stable premium option from Genworth or reduced inflation option from Transamerica and Unum. So it would be not 5% or 3% inflation protection, but it might be something else like 1% or 3.2%. Companies may put these offers in front of you to offer you a 0% rate increase. So if you have questions, please do reach out to the department. When you're faced with a rate increase, there are pros and cons to consider. Each policyholder is different. So when you're reviewing your options, consider these factors. Your age. If you are close to using benefits, you may not need to keep a high inflation option. You could consider 3% instead of 5% if you think that you're close to using your benefits. If you have current health conditions, the department would never encourage consumers to drop long-term care coverage. However, there are some situations like an unfortunate diagnosis or aggressive cancer or a fatal condition that might change the need for future insurance. That might be a case where a limited benefit would be a smart option. Are you close to needing institutional care? Consider lowering your inflation protection before reducing your benefit period. And again, we've talked about this before, but make sure if you were to increase your elimination period, you need to pay your premiums and you need to pay for your care during that period. So it's important to consider whether you have the funds set aside to do so. Think about your potential caregivers, marital status, and benefit settings as well. If a consumer is faced with a rate increase, they might go through some of the following exercises to look at options. So I have two here. One of them is changing your benefit period, which is the length of your policy, and another one is changing your inflation option. So I have an illustration here, but if you're on the phone, I'll talk through it. As we've seen before, the life of an insurance claim, we have a benefit trigger and elimination period, and then the benefit period begins. So if a consumer had a 5-year benefit period with a maximum daily benefit of $150 a day, the total bucket of money that would be available to pay long-term care claims is around $273,000. The consumer might consider changing the benefit period to only 2 years. At keeping the $150 a day, the total bucket of money that would be available to fund long-term care claims would change to about $110,000. So there's definitely a large loss. And the only other thing I want to say about the benefit period is that even though it says 5-year or 2-year, really the bucket of money is the important part. So if you're pulling money out of your policy a little more slowly, because maybe you have a home care setting rather than a nursing home, your benefit period could actually be longer than 5 years. It all depends on the speed with which you pull out the benefits in your policy. So that was a benefit period change example. And this is our life of the long-term care claim. And just noting that after the benefit trigger, there's an elimination period. And that's something that you can change. You could increase the elimination period to lower your premiums. And the last example I will show you is changing the inflation option. Inflation option helps your benefits grow over time to keep up with inflation. In this example, we start at $150 daily benefit amount, and the green line shows us the growth of the daily benefit amount over 15 years, growing from $150 to around $225 over 15 years. It's a significant amount of growth. If you were to reduce from 5% simple to 3% simple, you would continue to grow the daily benefit amount, but not as quickly. So starting at $150 a day and maybe getting up to $190 over a 15-year period. So that what you're doing when you change your inflation protection is you're changing the slope of the growth that you're receiving on your daily benefit amount. It's important to consider to talk to as many people as you feel necessary when faced with a decision like this. And that's why we've asked the companies to give a bit of a heads up to consumers when filing a rate increase so that you can start these conversations earlier. I've listed some places that you can get help considering your options. You can call us. We can't give you financial advice specific to your situation, but we can verify that the filing is accurate, that your rate increase letter is accurate, and we can give you some general information like this to help you on your path to finding the right answers for you. You can also talk to the company. You can have a financial planner with you. They may have many other options to show you, and they do have people trained to help ask questions that help you make good decisions. Family members, the producer, the financial advisor, or even a tax advisor if there's a cash option, which is unlikely. Oops, let's go back. And I just wanted to close by putting up our consumer services. Okay, you can reach out to me. My email is here, Anna.VanFleet@vermont.gov. I help people with this conversation all the time. We also have a tremendous consumer services team to help you not only with long-term care, but all kinds of insurance questions. Brenda Clark, Joanne Guile, and Katie Humphrey are standing by to assist you, and here's their number, 1-800-964-1784. I'll turn it back over to Pat, and thank you for your time.
Thank you so much for that awesome presentation, and I hope that that was helpful for folks. Okay, so we do have a few questions for you, Anna. So here's one from the audience. So if the benefit period is reduced for 2 years, but the bucket value of the policy hasn't yet been exhausted, would that then extend the coverage past that benefit period until the bucket value is exhausted?
Okay, so try to understand this question. So let's say there is a consumer who has had some care. So they started with a 5-year benefit period. They needed to use some care, but they were able to get back home and stop using the policy. So they've pulled out some of the value of their policy, of the bucket of dollars. And that person had a 5-year benefit. If they lower their benefit to a 2-year benefit period, then the company would take the amount of claim that has been paid out and subtract that from the 2-year benefit period. In all cases, the bucket of money is really the defining aspect of your policy. It's not really about a 2-year or a 5-year. That just helps people understand what might this money purchase for me. So it's usually about 2 or 5 years of nursing home care. So in any case, if you start out with 5 years, you pulled out some of the value, lower to 2 years, it would be your daily benefit amount times the number of days in 2 years minus any claims already paid.
Okay, thank you very much. Okay, and I have one more question for you. If I provide a written statement to the department with my objections to the rate increase, will I receive a written response from the department addressing my objections?
Absolutely. So if a consumer has comments, you're welcome to call us. You're welcome to submit a written comment. And we will certainly get you a written response to any written comment. We will also include your comment as part of the rate filing so that it will become a publicly accessible part of this public record for the life of public records requests. So while we may not be able to lower the justified rate increase because we're bound by these actuarial standards, and we do want the companies to be able to pay your claims. But so we may not be able to take action on your comment, but we will consider it and keep it and make it a part of the public record.
Okay, wonderful. Well, thank you so much. And again, feel free throughout our presentation today to chat your questions. All right, well, on that note, we're going to go ahead and take a 5-minute break. And so we will be back to you. Well, maybe we can stretch that to 8 minutes perhaps. So let's say we'll come back at 11:15. All right, everyone. All right, and stay with us. We'll be back.